Monday, July 10th, 2017, Monaco 64, home of alternative economics and contrarian views. So this is going to be a different kind of video. I'm going to talk about the bonds or the bond market. I make a lot of videos about bonds and interest rates and yields, stocks, precious metals, everything, all asset classes. And I get a lot of questions from viewers, can you explain a little more how bonds work or what you mean by the yield in the bond and interest rate and the difference. So this is going to be more like a tutorial. If there's more you want to know, just write it down in the comment, ask me, and I'll think of maybe another subject to talk about on a video. So basically, the capital markets, if you want to call them, you have the equity market, which is basically when you buy stock in a company. So you buy a share of the ownership in that company. You buy a stock, stock in the company. You have an equity participation in that public company. While a bond is when you lend a company or a government or an institution, when you lend them money. So actually you are a lender to them. You don't own them. You're a lender. And that's called a bond. You buy a bond, Microsoft bond, you buy a US Treasury bond, you buy a UK gilt bond or a British gas bond, whatever, company. And a lot of bonds, of course, are riskier than others, but that's a subject for another video. Basically, in the scheme of things, historically, bonds are safer than equity because bondholders are protected. They're ahead of equity holders in case a company goes bankrupt. They're ahead of them in the queue or in the line. If the company goes bankrupt, they'll get paid before shareholders of equity. And usually bonds have a term, which means a period of time that you lend the money for. It could be as short as 3 months. They would be called more bills, but still the same thing, a bond, or a year, 2 years, 3 years, 5 years, 7 years, 10, 30. Even now, I think Argentina did 100-year, borrowed for 100 years. So they issued a 100-year bond. Go figure, Argentina. But the other thing that bonds do, they promise you an income stream, the interest, or it's called the interest or the coupon on that bond. So let's say the US government borrows $100 from you for 5 years and promises to pay you 5% per annum, semi-annually, because the US Treasury, they pay the interest twice a year. It's still only 5% annually. I know that coupon is a lot higher than where we're now on the 5-year. I think the 5-year must be below 2%, of course, right now. But so let's say you buy, the US Treasury issues the bonds today. You give them $100 and it costs $100. It costs par. Usually when you buy it for $100, it's called par. And you get the 5% coupon, which means every year you're going to get $5 from the US government in interest. And they've promised to do that for the next 5 years. And at the end of the loan, they'll pay you back the $100. So you get back your $100 and you make the interest of $5 every year. And the price of the bond, though, fluctuates. Why is that? Why does it fluctuate? Well, because there's a secondary market for bonds. So if you buy the bond, the US government Treasury issues the bond today, you buy it from them directly, and then from when the auction is over, those bonds will automatically start trading in the secondary market. And the thing is, tomorrow, for example, something could happen to the U.S. finances or U.S. Treasury. They could announce something. They could say, "Oh, we're going to issue twice as many 5-year notes or bonds from next month," which means more supply of 5 years. That will probably make the price, of the 5-year bond that you bought today from the day before from the Treasury, that will make the price probably drop a little bit. So what that will do, the coupon will always stay the same. But if the price drops from 100 to 99, if you take 5 and divide it by 99, do the percentage, that yield will be higher than 5. And that's why you get changes in yields, because investors change their mind. They're saying, "Whoa, the U.S. Treasury is going to issue a lot more 5-year notes. No, I don't want to pay 100 for that now. I'm going to pay 99." And that's how the yields change, because the coupon is always fixed. So, and then let's say in a month's time, the U.S. Department of Labor, or the Bureau of Statistics, I'm sorry, it comes out with the CPI number, and instead of being 2%, the CPI, it comes out at 3.1 year on year. Well, you can bet that the bond investors are going to be concerned, and they're actually going to say, "I want more than 5.2% yield on my 5-year, seeing that the CPI is rising," which means that inflation is causing prices to go up. I want more return on my bond. So maybe the price will drop to 98 and the yield will go up. I don't know. I'm not really doing the right calculation, but let's say it goes up to 5.5%. So you bought these bonds or notes about a month ago, and you paid 100 for it. You're still getting the 5% on 100. But now in the secondary market, the price is going down to 97, and someone, your neighbor, John, can come and buy it for 97, and he'll be getting like 5.35 or 5.4 yield. He's going to get $5, but he's only going to have to put down $97, you see. So that's why the yield is higher. He doesn't pay 100 like you did. So that's how yields and prices change. And prices can also go above par. Well, let's say, the U.S. Treasury announced the day after you bought their bonds that they issued, that they're going to completely end the issuance of 5-year notes. Wow, that could jump to 102 or 103. So whoever, buys that bond the next day, he'll be getting the $5 coupon, but he's going to have to pay more, 102. So you could theoretically just go and sell it and make 2%, in one day. So that's how the bond markets work, and that's how yields work. With stocks, though, like equity, you do have dividends, but dividends they can be stopped. Corporations can announce dividends. They can stop dividends if business is not going well. So dividends are not guaranteed, but it's the same principle. If you buy IBM or whatever, XYZ Corporation, if you pay $100 for one share of that company, and the coupon, the dividend at that time when you buy is like $5 per share, you'd be getting a dividend yield of 5%. The thing is that XYZ Corporation could have bad earnings in a few months' time, and they will completely stop the dividend. They'll say, "Oh, we're not going to pay dividends anymore." So you're getting no dividend yield. But with a bond, unless the issuer or the borrower decides to default, they are obliged to pay you the coupon. And the coupon is always fixed. There are other kinds of bonds, but this is just the basics of bonds. There are floating rate notes or bonds, which means that the interest rate actually, the coupon actually fluctuates. But that's not the subject right now. I just want to get into the basics of bonds that you need to know when I talk about the bond market. And why is the bond market so important to the rest of the financial markets? Well, because it's the price of borrowing money. And if the price of borrowing money is going up, i.e. the yields, things are going to get financially tighter. Credit is not going to be as abundant, and economic activity will slow down. But the main thing to know is that the coupon is always fixed and is usually fixed when the borrower or issuer issues the bond in the primary market. And then that bond, once it is issued and people borrow that bond, lend to the issuer and buy their bonds, it starts trading in the secondary market. And that's where the prices change. And what can affect price of bonds? Well, the supply of bonds, inflation, political risk, corporate bonds, if a corporation is not doing as well, not earning as much. Central bank policy, in the last 10 years, they've been printing money to buy bonds. So that drives the price of the bonds higher and their yields lower. And then it also helps governments because as the yields go down, governments, are always issuing bonds. They have to issue bonds almost every month because old bonds come to maturity and they don't have the money to pay that off. So what do? They issue again, but they've been issuing at lower coupons because the yields have been going down because central banks have been buying. So that's the mechanics of bonds. The main thing to remember is that bonds are a loan and they promise you, interest payments. It depends on the issuer. U.S. government, they pay coupons semi-annually. The German government pays it annually. So it makes a little difference in the yield because it's theoretically you can, when you get paid after 6 months by the U.S. Treasury, you can reinvest that coupon into your bond portfolio and your yield will actually go up a little bit because you put more money into that. But that's another story as well. So coupon is always fixed and the prices change and that affects the yield. And bondholders are always ahead of the queue in terms of financial trouble for the issuer. Equities are riskier because you buy a share in the company. You're not lending money to the company. They're riskier, but they're also more profitable. If the company does really well, your share might be worth a lot more. Bonds are safer. The bond price can go up, but not as much. Doesn't have as much welly as equity. So if you enjoyed this tutorial, give me a thumbs up, share it far and wide, subscribe to my channel if you haven't yet. And also follow me on steemit.com. That's STEEMIT.com. I'll talk to you later. Bye.